Hello, Stephen. Welcome to the Value Investing
Hey,
YouTube
everybody.
channel. It's great to have you here at the International Value Investing Conference in Luxembourg. We would invite you to introduce yourself to our audience.
My name is Stephen Wood at GreenWood Investors, and we take a global deep value special situations approach to markets. We're optimizing from a bottoms-up basis on three different continuums. So risk-adjusted return, which is another way of saying valuation. We also screen and optimize for quality, which we take a more conscious capitalist approach to that quality. And then the expectations gap. So where does our assessment of reality differ quite dramatically with the markets? Because our near-term performance is always going to be driven by those periods in which reality is very different from what the market expects. Which is why we've taken a little bit of an approach to keep things to ourselves a little bit. But we love sharing and spreading the gospel of conscious capitalism because not enough people in the world are looking at it that way. So it's very much a bottoms up, and it's just a sort of a best ideas fund is how we run things.
Before we go deeper into the topic of this talk, the conscious capitalism, I would like to ask you to go a bit back in history and tell us a bit about your way into value investing and how it grew.
I started with the Kellogg family and then with a not well-known family called the Carucci family, but they were best friends with Warren Buffett and Ben Graham because they were the prime broker for Graham Newman. But so it's a very much family approach to markets, and so we can take volatility, we can look through periods of uncertainty, which I think a lot of value investors sort of benefit through. We're taking near-term visibility risk, which a lot of other short-term people can't take, for hopefully what is a very low-risk long-term outcome, because ideally the value of that firm is compounding so quickly that it almost doesn't matter what happens in the near term. In 2-3 years out, there's almost no way to lose money.
You already mentioned the conscious capitalism approach.
Yes.
That made your work progress. Can you tell a bit more about the book and how it influenced your work, please?
So Conscious Capitalism was started by John Mackey, the CEO of Whole Foods, and because we were looking at Whole Foods as an investment, and it was a fairly contrarian investment, I read the book, of course. It's the best way to get into someone's mind. And he was really the first person to start talking about quality the way that I think about quality. A lot of people on Wall Street think about, they look at the results and they say that is quality. And unfortunately that will allow you to get wrapped up into things like GE under Jack Welch's period, and Valiant Pharmaceuticals, because the results have been so staggering that you can sometimes confuse yourself with actually like what is high quality. What is high quality in our opinion? Well, if you study the value creators throughout time, they're generally not profit maximizers. And I know that sounds a little bit counterintuitive, but the best performing companies over time have lower profit margins than their peers and the market does, but they have significantly faster growth. So they're willing to pay the best employees a lot more than their competitors are willing to pay the bottom end employees. They're willing to spend quite a bit more on R&D, on capital expenditures. They treat their suppliers well, and so when their suppliers have an innovation, their suppliers bring them that innovation first, and they have that industry first. They're, of course, as Jeff Bezos has sort of explained to us, they start pretty much with what the customer wants, and they don't profit maximize that customer. They do whatever is right for the customer, right? Which breeds that incredibly sticky customer and builds that competitive dynamic, that competitive advantage. And so it's quite a bit different. You wouldn't really hear too many people on Wall Street talking about trying to extol the virtues of low profit margins, but oftentimes it is actually indicative of someone that's actually investing. Now, think about it this way too. A significant amount of those expenses that are actually lowering the earnings of the business are actually being capitalized as a negative valuation, and a lot of times that they're actually an investment. And so one of our favorite investments today that we can't really talk about, the thing that we're most excited about within the business is negative earnings right now. And so not only are we getting the investment for a substantial discount to just peer valuations because the margins are lower, but that is seeding when we look 3, 4, 5 years down the road, that investment is going to be the highest performing investment within the portfolio of their companies. And so it's sort of it's sort of inverting what you would normally hear of from a normal quality perspective. We think it's quality. You can also really measure this. Like sometimes it's actually you would take more of like a gut or an intuitional level A, B, C, D, E, F, or A through F. But you can Glassdoor allows you to see what employees rate the company as. You can look at customer satisfaction indexes. You can look at net promoter scores. A lot of actually industrial guys have supplier awards, and so you can pretty easily tell who loves doing business with someone. And a lot of times those companies are valued at a very extremely high valuation, and so we would probably not look at a large portion of those. But every once in a while you find the best performing management team with the most sound operational plan, like Fiat Chrysler, which has outperformed the industry by an incredible amount, is actually given the industry's worst valuation because this guy just thinks and looks at the world quite a bit differently from the rest of his peers. We love that.
With Fiat Chrysler, you named a company that has its roots in Europe, and you also have a high exposure in your funds to Europe. Can you maybe name some other European companies that are interesting in the sense of conscious capitalism?
So, and again, I think conscious capitalism would take a little bit slightly different approach to how we're calling a sort of a builder's approach. But conscious capitalism will also look at sort of environmental factors, which we think is actually really important, because another way to think about conscious capitalism, which we can go into, is if you're creating positive or negative economic externalities, eventually those usually have a way of catching up with you. And look at how the Dieselgate issue just basically cannot go away from Volkswagen. It's because they actually haven't solved the significant negative externality they're imposing on society. And conversely, actually, Whole Foods was basically upgrading animal welfare standards of the entire industry, the farming industry in America, which, as Europeans would probably know, we have a lot of room to improve on our food standards, and that was actually just all free. That was not actually, we were not capturing any of those economic benefits, but it did create this massively loyal customer base. The question you answered about, or that you asked about European businesses, I wouldn't say that conscious capitalism would necessarily really agree with me, but we love, I'm going to present today Exor and Bolloré. These are owner-operators that look at the world really quite a bit differently from the rest of their peers. And their outperformance of their peers and their benchmarks has been just completely significant, because they're basically willing to forego short-term quarterly profit maximization, and they invest for that sort of medium and long term. Not that they ignore the short term, because if you can't survive the short term, the long term is no good. And so that's where Exor has really, Exor and Fiat Chrysler have demonstrated sometimes crisis is the best thing that could possibly happen to you, because you optimize for that short, medium, and long term. They're pretty much fully optimized. Whereas you have a consultant-led, it's basically a company that's being driven off of a Bain Consulting presentation, which is GM, which is doing everything that investors want them to do. Stock still just goes nowhere because they're actually not generating, in my opinion, any real value for the long term. The idea that if the auto universe is about to go towards sort of an iPhone moment, and you can either be Apple, you can be AT&T, or you can be Samsung or Foxconn. The idea that GM becomes the Apple of the industry is a little bit of a long shot. And so, yes, there might be a 5% probability that that they basically own autonomous. The likelihood that actually they lose to Google is really, in my opinion, really quite low. So that entire investment is probably going to be worth nothing one day. And then you're basically left with a company that hasn't really focused on the rest of its business, right? So that's pretty controversial, because a lot of value guys will like GM. I would say there's actually there's been no strategy, whereas Fiat is focused on becoming the lowest cost manufacturer. They want to be the Foxconn of the industry, and the probability that they actually get there is probably 90%. And so, maybe it's a little bit underwhelming to say we're just going to generate a 10-15% return on capital, but it's better than a negative. So, sorry, that's a little bit controversial, but we like Bolloré, we like Exor. Look at Rolls-Royce, another one of our favorite positions right now, actually, where that expectations gap is really quite wide. Everyone's focused on this $1 billion free cash flow target. They don't even realize that they're already there today, if you exclude some of the one-time charges. And $1 billion is really just the start of the journey. But from a conscious capitalist perspective, All of their market share gains are fueled by their engines being significantly more efficient than their GE counterparts, right? So if you think about carbon emissions in the environment, the only way that Rolls-Royce is actually going to win is by continuing to make their engines very, very efficient. And so it's sort of a win-win where the customer wins because they have the most efficient planes, the environment wins, and then eventually the airlines will pass all those savings on to the customers, and so their customers win too. So that's what we're always looking for, sort of win-win wins in a conscious capitalist approach. Does that make sense?
It makes sense, and the question that comes in my mind is, what is somehow the difference between the concepts that are also circulating, ESG, and impact investing in your mind compared to conscious capitalism?
I fully support ESG, and we will look at those indices from time to time. But I've never wanted to brand my firm as an ESG firm because I feel like that's a little bit of greenwashing. Let's be honest. We're deep value, high quality, profit maximizing investors for the medium to long term. And so ESG is one way that we'll look at it, but we will look at an oil company, particularly if it's bombed out. We've done really quite well with a few oil companies, right? So I think ESG is actually quite important. But I think it's one small window into I think we really should be evaluating quality. But ESG would probably, it's not even going far enough. We really think about the externalities that a company's creating. And I don't think ESG really goes into trying to quantify some of that. But if you look at, like, for instance, like with Dieselgate, and this is an industry-wide phenomenon. It's not just I'm not just trying to pick on Volkswagen, although we're short Volkswagen. Not the negative health ramifications for NOx emissions, and us having lied about them for 10, 15 years, is like the dollar figure of like the health impact of that is really just it's so massive that if this ever catches up to them, the companies, it becomes almost an asbestos style liability, right? So like I don't think many people on Wall Street, if it's not flowing through the P&L, they don't care about it. And so if you can look at the externalities, that positive and negative that someone's created, Google, Amazon, Apple, I'm not sure about Netflix, but create significant positive externalities, right? They're not monetizing so much value that they're providing to their clients, right? And that also creates an incredibly sticky customer that will never go anywhere and will allow them to sell significantly more services and products over time because they do so well first to the customer. See, ESG wouldn't even look at the customer. I think that's actually the number one consideration you should look at in most of the most investments.
Let's look to.
I'm not trying to put down ESG. I hope I'm clear on that. I think it's a really important lens. It's just one lens that you can use, and it's to a man with a hammer, everything looks like a nail. I don't want to actually just have one hammer. We're trying to optimize. One of the beauties of our process is we're optimizing on so many different continuums. We're really almost on 4 continuums at this point. So we're not going to get the deepest value stock or the highest quality Amazon stock or the battleground stock like Tesla that everyone is like either hates or loves. But we're going to go a tier below that. And so we're going to go really quite cheap, but really quite high quality and also really kind of confused. That's the best area that we can be in. Because most investors focus on one of those buckets, they're focused on those extremes. We're in sort of less crowded opportunities, which is what I'd always prefer, is go where the competition is not.
And as I understand, your approach also has a certain impact because you're looking at positive externalities and win-win situations in the companies.
On alongside, yes, yeah. Hopefully, right? So all of the, in fact, Rolls-Royce has done an incredibly bad job at capturing the value they've created through their lower fuel burn. All of those economics have either gone to the airlines or Airbus in this scenario. Airbus was able to price their A330neo quite a bit higher, and then and their A350 is coming out of the gate with a quite nice price. They're almost break even in 3 years into the program, and so that all of that lower cost of operation was enabled by Rolls-Royce, which they actually didn't do a great job of capturing. At least they got the exclusive on the A350 to capture some of those longer term economics.